Welcome to the Real Estate Guys radio program and happy holidays. I'm your host, Robert Helms. Well, they did it. The Federal Reserve raised the interest rate. But what does that mean for real estate investors? That's what we're going to talk about today on the Real Estate Guys radio program.
If you love real estate and have always wanted to own your own business, listen up. The Real Estate Guys and their panel of experts want to teach you how to go full-time fast in the real estate syndication business. These next few years may go down in history as one of the best times ever to acquire investment real estate. There are deals everywhere if you know where to look and how to assemble the resources. The Secrets of Successful Syndication seminar will show you how to make big money doing big deals from a team of experts that have syndicated projects totaling more than $1 billion. Don't wait for someone to give you a raise or create a job for you. Attend the Secrets of Successful Syndication and learn how to build a team, raise capital, find deals, and make full-time money in 6 months or less. Go to realestateguysradio.com and click on events. All the big players use syndication as a way to diversify risk, optimize profits, and earn big money. You can too. Go to realestateguysradio.com and click on events.
Welcome to the Real Estate Guys radio program. I'm your host, Robert Helms. Let's say hello to our co-host, financial strategist, Russ.
Hey, Robert.
And ho, ho, ho.
Yes, I am.
Yes, you are. And we love this time of year. Lots of great stuff going on. Hopefully you're with people you care about a lot, and stay warm. Today, we're going to talk about the thing everyone's been talking about the last few weeks, which is the interest rate increase by the Federal Reserve. They've not done it for years and years and years. And finally, Janet Yellen stepped up, and despite our friend Peter Schiff saying she's not going to be able to raise the rate, raised the rate in a range of up to 25 basis points.
Right. So just no investor left behind. A basis point is 1/100th of a point. So 25 basis points would be 1/4 of 1%.
And so previously the target range was between 0 and 0.25. And now the target range is between 0.25 and 0.50.
Yeah. And actually, I listened to one of Peter's podcasts the other day that was kind of talking a little bit about that. And this is a very difficult thing to interpret. Obviously, you can see how large the Fed's influence is. Every financial talking head on earth has been watching and waiting for this move. There are people listening to this podcast that were in junior high school the last time the Federal Reserve moved the interest rate up. And it was a very, very minor move. It had been extremely well telegraphed. The purpose of telegraphing, which is, the Federal Reserve coming out, hey, we're going to do it, hey, we're going to do it, hey, we're going to do it, is giving everybody plenty of notice to reorganize their positions, restructure their portfolio to adjust for whatever they think is going to happen as a result of this raise in the rate.
Which is why in the news you hear that this was already priced into the market.
Right. And of course, because of that, sometimes the market does things you don't expect. Theoretically, this was a tightening, which would be constricting of the money supply, and normally that would mean the stocks would go down. And yet the day it was announced, the stocks went up.
Right.
And part of that is because the announcement was accompanied not just with the move itself, but with a tone. And the tone was dovish, meaning they're less likely to move quickly and aggressively. This isn't maybe necessarily the first round in a rapid volley of rate increases. It was really communicated that this was going to be a very delicate, very slow, very tender, very gentle move.
Which it kind of had to be, given the fact that there's not been a move in 9 years.
Well, one of the big concerns around the world is the strength of the dollar. We've talked about that in our blogs and our newsletter. And, it's hard to spend a bunch of time in this space and not get disconnected from what's going on the street, right?
Yeah.
But you have to understand that corporations have been making decisions about taking their profits and borrowing at cheap rates and then reinvesting in their stock. That creates better earnings per share, which creates a wealth effect, which means people are more prone to go out and spend. And that means that they might buy a house. They might push up the demand for houses. So these macroeconomic things do trickle down to Main Street. Obviously, job creation is huge. One of the things that came out of this the day that the interest rate was raised was that oil dropped 3%. Oil has already been at 11-year lows, and then within, I think, a day or two, it dropped another 1%. That's a 4% loss. So you've got oil that was priced over $100 a barrel, now all the way down in the 30s. And the reason that's significant to real estate investors or anybody who cares about the financial markets is you have these banks and these major bond buyers have been funding the borrowing of these energy companies to go out and develop oil. And a lot of them are pumping oil right now at losses. Like it's on the P&L, it's a loss, but it's cash flow that keeps the doors open a little bit longer, hoping that the rates are going to come up. Just saw an article in the Wall Street Journal the other day talking about banks and how banks are betting by continuing to extend credit to these leveraged operators, these oil operators, that the oil price is going to go back up and they're going to be able to save themselves. If the banks get that bet wrong, those debts will go bad, and it could be a whole lot bigger than the subprime crisis ever was.
I seem to remember a lot of real estate investors that had that same kind of mindset that, hey, next month the price is going to go up and next year the price is going to go up and every market goes up. And lo and behold, that isn't the case. A lot of folks in oil super concerned about this. And your point's a good one. It's not only that some producers of oil today are continuing to produce oil even at a loss. It's that, of course, exploration stops, new drilling stops, and all of that means those jobs stop. And many of those jobs are tenants.
Well, and that's the main point, because if you go back and you net out all of the job creation from 2009 until today, and it doesn't mean it's the only place the jobs were created, but if you look at the gross number of jobs created and the gross numbers of jobs lost, there was a net number. And if you look at that net number, you could assign 100% of that net number to the oil and energy space.
Yep.
That's how important it's been to this U.S. recovery. And right now, it's arguably one of the most distressed areas of the economy. So if you've invested in marketplaces that are strong in energy or are strong supporters of companies or areas that are strong in energy. That's where we talk about the concept of primary and secondary and even tertiary jobs. These secondary and tertiary jobs, a lot of whom are your tenants, are all based upon the income being derived in the selling of oil. In fact, Congress and the president just lifted a 40-year ban on oil exporting. And I'm sure part of that is to try to figure out a way to generate more revenue in the oil space. So oil is something, I think we all need to be paying a lot of attention to because of the impact in the debt markets and the bonds, which come right back into the availability of credit and mortgages, just like the subprime crisis. It's had a lot to do with the net job creation, as I mentioned earlier. And so again, that's been a big story in the economy and the recovery since the Great Recession. If that job creation begins to slow down, that will have a net effect on the price of real estate, the number of tenants, the demand, the strength of wages, job creation, and all of those things. So that's a very important point. And if those debts go bad and it rolls into the banks, that's where we had the big bailout last time. And so today with the Dodd-Frank rules, it's not as easy for them to bail out. And that means if they can't go to that path, where else might they go? We don't know. It's very, very uncharted territory. So the good news in all of that, of course, is that anytime there's chaos, anytime there's uncertainty, anytime there's change, there's going to be little gaps, little pockets of opportunity for the people that are thinking about things, that are paying attention. I wish I could just sit here with a crystal ball and say, hey, everybody, look, here's where all the opportunity is. I'm not that smart, right? I think I'm smart enough to know I need to be paying attention. I'm spending a lot of time listening to what people are saying about it and trying to figure out, what does this mean to me? What does this mean to real estate investors? What does this mean to the cost and supply of money? What does this mean to credit? What does this mean to jobs? What does it mean to income? What does it mean to taxes? Where is the opportunity going to be? And I think it's a process that will unfold over time. It's not just going to show up on your doorstep in a little package for the holidays and go, hey guys, here's where the opportunity is. It's going to be something that unfolds over the next few years.
That's such a good point. Anytime there's major market news, there's whatever reaction. But a lot of times you hear this whole thing about, that's already been priced into the market. People knew that was coming. This is obviously something that was anticipated. And so we can't expect it all to happen on day one. If you think just in a logical point of view, all right, if the rate goes up, that's going to have some effect. We have to first step back and say, well, what rate are we talking about? This isn't the rate that your credit card charges you. This isn't the rate of home loans. Let's talk about what exactly this rate that got hiked by the Federal Reserve really is.
Yeah, this is the federal funds rate. This is the rate that the banks loan to each other in overnight lending, and it's designed to prevent a liquidity crisis. It means that if Bank A has more withdrawals than cash on hand or deposits coming in, rather than run out of money and have to close the doors, they just borrow from another member bank.
At a nominal, in this case, interest rate.
Yeah. There's another rate that didn't get announced, and it's not the rate that everybody's focused on, but it's the rate that the Fed pays on banks on their excess reserves on deposit with the Fed.
Yeah.
And if they get a good rate, a higher rate, it encourages them to put more money there, which pulls money out of the economy. That's why this is considered to be tightening. This is not accommodative. And yet you could make the argument that the interest rates historically are still so ridiculously low, and the Fed has still kept all of these assets, the $4 trillion of assets they purchased going through the crisis, still on their balance sheet. So this is a long way from being tight, and it is a long way from not being accommodative. So the Fed is right in telegraphing to everybody, this is going to be done very, very, very slowly. And the danger is that as investors, we don't pay attention to the little changes that are kind of setting the direction and the tone for what's coming 5 and 10 years down the road. And as real estate investors, we arguably have to be even more attuned to that, because when we're making investment decisions, we don't jump in and out of positions the way stock and bond traders do. What we do is we evaluate a market. We look at its economic drivers. We look at its economic prospects, its migration in and out. We look at the legislative environment and how friendly they are to business and job creation. And then we make a decision to really get married, or at least get into a long-term relationship with that market. And then we sign on a 20 or 30-year mortgage, and we put a bunch of capital in there, and we're prepared to be in there for several years, if not decades. And so when you're investing that way, you have to pay attention to these long-term trends, because like everybody who's trying to figure this out, we all want to be ahead of the curve. And this is a very slow moving curve, and it's easy to fall asleep at the wheel. And then one day you wake up and everything's changed. And by the time you figure it out, if you've been asleep, everybody else ahead of you has figured it out. And now you're all rushing towards the exit, and the exit is crowded. So you want to be paying attention early.
So when we come back, we'll talk about the myriad ways that this interest rate hike can affect and will affect real estate investors. We'll make some best guesses as well. You're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Live nationwide, you're listening to the Real Estate Guys. Find out more at realestateguysradio.com.
When the housing market crashed in 2008, San Antonio led the way in appreciation and cash flow. Would you like to have a strong, reliable investment that performs in both up and down markets? Cash flow is the key to successful investing, and we have tons of positive cash flow properties for our ATW investors. Come see why the Milken Institute rated San Antonio the #1 economy in the United States, and why San Antonio is the only major city in the country to have a AAA bond rating. ATW Investments can teach you strategies for building strong, secure wealth with investments starting at $5,000. ATW's patented, proven, and powerful system will do all the hard work for you. ATW is where the perfect market meets the perfect strategy and produces the perfect results in your portfolio. To get started, go to the resource section of the Real Estate Guys website or email us at contact@atw-investments.com.
Are you ready to profit in paradise? Hi, it's Robert Helms, and if you think real estate investing means tenants, toilets, and termites, think again. Located just a short plane ride from the U.S., a virtually untouched paradise awaits, the beautiful country of Belize. When you go to Belize with the Real Estate Guys, you'll spend 4 fabulous days discovering one of the most intriguing real estate markets I've ever seen. With its jungle rainforests, pristine beaches, and 81-degree turquoise water, Belize is one of the most beautiful places on earth. Plus, it's considered one of the top 7 tax havens in the world. Belize property is on the rise, and many experts think the best is yet to come. But don't just take my word for it. Come experience Belize firsthand at our upcoming investor field trip. When you join us, you'll discover the many reasons we love Belize, like tremendously undervalued beachfront land, super low taxes, ease of doing business, and so much more. Get the details at realestateguysradio.com. Just click on events. See paradise for yourself. Click events at realestateguysradio.com, and I'll see you in beautiful Belize.
Hello, this is Dave Lendiger, co-founder of RE/MAX International. You're listening to The Real Estate Guys.
Welcome back to the Real Estate Guys radio program. Thanks for tuning into the show. If you're trying to figure out what you want to do with the rest of your life, come on out and join us at Creating Your Future. The 2016 Goals Retreat happens the second weekend of January in beautiful San Diego, California. You can really get your life on track and spend some time figuring out what you want to do when you grow up. You'll find all the details on our website at realestateguysradio.com under events. We're talking about how the Federal Reserve interest rate increase will affect you as a real estate investor. And I think one of the things to talk about, of course, is we think interest rates, we think mortgages. If you have a mortgage in place that's a fixed mortgage, this doesn't affect that in any way, shape, or form. So part of the reason that as real estate investors we look at encumbering property with leverage is that we love the magnification of return. However, given what the market gives us, and Russ, you were talking about before the break, we're in it for 20, 30 years. If the mortgage money at the time is affordable, like it has been for many, many years, then lots of real estate investors opt to get into fixed rate product. And that makes a ton of sense and has for a long time. We've been through the other side of it. We have enough gray hair to have been through the time where adjustable rate mortgages made a lot more sense for particular investors in certain situations. It's always about you and your investment strategy, how long you're going to hold the property. But is this small increase also going to eventually translate into an increase in mortgage rates?
Well, I think the thing to think about is just really understanding where mortgage rates come from. And it's gotten to be a lot more complicated, which again opens up a much bigger discussion because you have many of the rules, kind of the cause and effect things that we get used to when we try to figure out how things are going to work, and they don't work the way they're supposed to. And that's because you have people who are trying to create outcomes by moving results. So they move numbers on the results column, and so the causation doesn't seem to match up. You're like, okay, I don't understand. If this, then that, but that didn't happen. Why didn't that happen? That's because somebody's manipulating the result to try to make it look like something else. And so there's a lot of that going on. You can call it conspiracy theory. You can call it professional management of markets. You can call it smoothing out the rough edges and stabilizing the economy. It really doesn't matter what you call it. I think everybody agrees it goes on, and it just makes the job of figuring out where things are at quite a bit more complicated. But in the basic picture of where mortgage rates come from, it's based on supply and demand. So if you have a lot of people who want to borrow and not very much money available, the lender can charge a high rate and the weaker people get priced out and only the strongest people can borrow.
Sure.
You flip it over and there's a lot of money that needs to be lent and there aren't very many borrowers. Everybody's dropping their interest rates, offering free toasters and, we'll pay your points.
Or lowering their standards.
Trying to get more people to borrow. And, we've been in a very, very, very accommodative scenario where there's been a lot of money pumped into the market specifically to goose real estate. And largely it's done that. You have a lot of prognosticators out there saying we're in a bubble and the bubble's about to burst. And in some markets, I suppose you could make that argument because a bubble is when the incomes that need to debt service the mortgage don't go up as fast as the payments do.
Right.
In other words, that can happen because the rates adjust, but if the load of debt just gets so high that monthly payment gets to be too much, even if it's a fixed rate based on how fast incomes are rising, you're going to hit a plateau where people just can't borrow anymore unless either the rates come down or their incomes go up. Well, nobody's running around saying that incomes are going up at any substantial level. Now, the Fed says they think that's going to happen. So part of the effect of the mortgage industry is what's going on with incomes. So it's supply and demand and what we call capacity to pay, which comes from income. It used to be anyway that when the stock market was hot, money would come out of bonds, people would sell their bond positions and they would go into the stock market to participate in the growth. That would make less money available in the bond market, which would mean less money available to lend, which means that rates go up. So typically when the stock market goes up, rates go up. That's the way it used to be.
Yep.
Post-crash, that changed. Pretty soon, bonds were able to go up, which meant interest rates went down, and stocks were able to go up. And that didn't seem to make sense based on the old rules, but it made a ton of sense when you realized the market had been flooded full of money.
How much quantitative easing and money printing, and the money had to go somewhere. The squish factor, when there's more money injected and you squeeze your hand around it, where's it going to come out? We don't know. It's going to come out somewhere. Where it didn't go is into the hands of businesses and even into real estate investors' hands to go do something with it. A lot of that money got stuck.
Yeah, and the money that did end up in the real estate space went in through hedge funds who bought for all cash and didn't even use mortgages.
Yep.
And so you've had that. I'm not going to call it a distortion, but it was definitely a new factor that didn't exist in real estate 15 years ago.
Add that, you had the knee-jerk reaction of lenders, and rightfully so, of all the crazy loan product that they got stuck with in the downturn and all the defaults and all the foreclosures, and all of that meant that the lending standards increased, and it became harder and harder and harder to get a basic consumer loan. Even if you had a good job and good credit, more hoops, more federal regulations, more state regulations, harder to get a loan, even though you can say interest rates are low and it's an affordable time to leverage. Not everybody could get a loan.
Right. And historically, the last time this happened was after the savings and loan collapse, which was really the birth of creative real estate. If you really think back and you go back and look at the history of real estate in, modern history anyway, in terms of creative finance, a lot of that was birthed when we had those ridiculously high interest rates in the wake of the savings and loan crisis.
Well, of course. See, people figure it out. When there's a challenge, it also creates an opportunity. When interest rates went to 18, 19, 16, pick a number, when interest rates were like that, you got creative. You figured out a way to make it happen. And there were all kinds of crazy, fun, interesting ways that the folks did that. And a lot of that has continued on today in various formats.
Yeah, and that was really the birth of the non-agency lender, the brokerage channel. About 30 years ago, and it grew to where it was originating 3/4 of the loans, the real estate loans in the country.
And if you have a tinfoil hat, this is where you would put it on and say, and the entire meltdown was really orchestrated to remove that channel, but we're not going to go there.
Yeah, we definitely had some people in the mortgage industry who felt that way. I was in that channel and I got wiped out as a result of it, so I know exactly what that felt like. But, whether it happened on purpose or whether it happened by accident, at the end of the day, it happened. And then the role of the government and government lending came back. Well, if you've been paying attention, you're seeing more non-agency money coming available, more private money coming in. More money has been printed, more money is looking to get into the mortgage space. So coming back to rates, now you've got the agencies who are subsidized, right? That's why Fannie and Freddie keep losing money more often than not. Sometimes they make money, but more often than not, they lose money. They're a subsidized rate. They have access to money cheaper because the interest rate on a mortgage is based on risk. And when you are lending money, buying a mortgage bond, right? If I'm buying a mortgage bond issued by Fannie or Freddie, I had prior to the crash an implied government guarantee, but not an overt government guarantee.
Right.
Today I have an overt government guarantee.
I'm not sure that's any better.
Which means it's less risky, which means that I will accept a lower interest rate. So when I don't have that overt guarantee, if I'm another provider of funds in the marketplace, I have a higher cost. But I may be able to compensate for that with more efficient operations or whatever. So I go in and I try to compete, but I also may compete off a little bit to the fringe. So we're seeing more of those non-agency players come back in and begin to compete.
And by the way, on next week's program, you're going to meet one of those folks. You're going to learn a lot about these new loans that are available to real estate investors, including the fact that you can basically forget about getting Freddie and Fannied out today. There's a lot of new alternatives. Excited to talk about that next week.
Yeah. So a lot of people are motivated to see people be able to finance real estate. We've always made the argument that the powers that be, whoever they are, whether it's government, politicians, banks, private industry, the largest trade association in the country is the Realtor Organization. So you look at all that and you say there's so much political and financial benefit to seeing real estate get propped up, even if it has a problem like it did. It just had the biggest problem ever in 2009. You see everybody rally around it. And if you're willing to wade into the mess, you actually can make a lot of money. A lot of people made a lot of money coming out of 2009. And there's some of us that are sitting around looking, we hope this is a bubble.
Right.
We hope this thing pops. We hope that this 1/4 point interest rate increase actually pops it a little bit and some of the prices will come down because the rents probably will not come down as far as the the prices will. And if that happens and money remains cheap and we get to go in and purchase, we'll actually get a chance to scoop up some bargains. And that's obviously what everybody's hoping for.
And before we're done today, we will talk about some of the strategies that you might consider given what's happened.
Yeah. So in terms of the interest rates themselves, obviously mortgage interest rates are going to stay very low. And if you really want to get some idea about where they're headed, I would pay attention to the 10-year Treasury bond. That's really the epicenter of where risk pricing is in the debt markets, at least as far as mortgages are concerned. And so if you can imagine the 10-year bond yield at the center of a bullseye, then each concentric ring out is a little bit more risky. And you could make the argument that real estate is just slightly more risky than a government bond. And so there's going to be a little bit of a spread. You can go further out all the way to another topic that's been quite a bit in the news lately, junk bonds that are way out in the outer rings, right? Because these are basically poor credit corporations that are borrowing to fund maybe negative cash flow operations, like we were talking earlier about the oil companies, and they're high risk, high reward investments. If you make that loan and you get it right, meaning I buy that bond and loan that money company and they pull themselves out of the fire, they owe me a lot of money. I can do real well. But the flip side of that is they could completely default and then I get maybe pennies on the dollar if I'm lucky in a bankruptcy proceeding or whatever. So mortgages tend to be very near, and they are the beneficiary, if you will, of flight to quality, just like bonds are. So as people get nervous about all the gyrations in the economy, they jump into treasuries and the dollar, which is why both the dollar has been strong and treasuries have been strong. That pushes yields down. So when people are bidding up the treasury bonds, bidding up the price to buy them, the inverse of that is they're bidding down the yield. So I would say that if this quarter point raise creates uncertainty in the market, and clearly the stock market is not liking it. It liked it the first day. Maybe that was the plunge protection team trying to create a PR move, but since then hasn't liked it so much. If that trend continues and people start looking for safety, you're going to see them move more and more into bonds. And if that happens, then you're going to see those 10-year yields begin to come down, and that will be reflected in mortgage rates. So personally, and I'm hardly a genius at this, but I've been watching these markets for a very, very long time, I really don't see mortgage interest rates running away. Does that mean you should run around and use adjustable rates? I don't think so, only because the chances of them going up substantially versus the chances of them going down substantially, I think you have a greater chance of them going up substantially just because of where they're at. They're so far near the bottom right now. Why take a chance, right? Because, if all of a sudden the credit market sees up or we get a big boom of inflation and we have to raise interest rates real high to cool it off, or everybody runs out of bonds because bonds are losers in an inflationary environment. Everybody will be running into stocks and other places. Money will be coming out of the bond market, and then the bond prices will go down, bond yields will go up, mortgage rates will go with them. So that's kind of the way it works. Again, these markets are managed, manipulated, whatever you want to call it. So they don't always act the way they're supposed to act, at least in the short term. But if you watch them over the long term, usually the market behaves as you would expect it to do. But you just got to look at it over the longer term.
We're talking today about how the Federal Reserve's interest rate hike is going to affect us as real estate investors. More when we come back. Plus, we'll play real estate trivia next. You're tuned to the Real Estate Guys radio program. Merry Christmas.
Real estate investment advice right in your mailbox. Sign up for the free Real Estate Guys newsletter at realestateguysradio.com.
Hi, this is Patrick from Paradigm Life. I've recently written an ebook called The Perpetual Wealth Strategy. The ebook discusses one of the best investments, real estate, combined with a financial vehicle used by the wealthy, many U.S. presidents, famous actors, athletes, and even Houdini himself. You can download the ebook for free in the resources section on the Real Estate Guys Radio homepage. Don't wait. Go download it now.
All aboard! Registration is now open for the Real Estate Guys 14th Annual Investors Summit at Sea. Imagine spending an entire week with like-minded investors, world-class educators, and real-world professionals. Returning this year are sales legend Tom Hopkins, international developer Beth Clifford, attorneys Mauricio Raoul and Jeffrey Verdon, and the author of The Creature from Jekyll Island, G. Edward Griffin. New for this year, commercial mortgage broker and syndicator Michael Becker, personal development icon Kyle Wilson, and Ken McElroy's partner Ross McAllister. And joining us live and in person for his third Investor Summit, Robert Kiyosaki. It all begins February 26, 2016 in Miami, Florida. Visit realestateguysradio.com and click the tab that says Summit to learn more and reserve your spot. This transformational week is like no conference you've ever attended. Go to realestateguysradio.com and click Summit and make plans to spend a week with the Real Estate Guys and an all-star faculty on the 14th Annual Investor Summit at Sea.
Hi, this is Gene Epstein, economics editor from Barron's, and you're listening to the Real Estate Guys.
Welcome back to the Real Estate Guys radio show. Thanks for tuning into the program, whether you're listening on the radio or via the podcast or in any other way. It is a pleasure to have you here. The interest rate has been raised by the Federal Reserve. We're talking about what that means to real estate investors. Before we get back to that discussion, it's time to play real estate trivia. And we love to give away a prize for real estate trivia, but especially this time of year. So in just a minute, you're going to hear our real estate trivia question. As soon as you know the answer or want to take a good guess, all you have to do is send us an email to trivia@realestateguysradio.com, trivia@realestateguysradio.com. Now, you do need to send your name, the answer, and a full mailing address so that if you're the winner, we can send you a copy of Tax-Free Wealth, the great book by CPA Tom Wheelwright. Last week on the Real Estate Guys, we were talking about the new rules for crowdfunding, and we asked this: in what part of the world was the fork invented? Well, Governor Winthrop of Massachusetts introduced the fork 10 years after the first Thanksgiving feast, but it didn't really catch on until the 18th century. So the part of the world was the USA in Massachusetts. Here's our real estate trivia question for this week. After 19 years of broadcast, it is harder and harder to find a good holiday real estate trivia question, but I think we have one. Here it is. In what country did the red poinsettia originate? You see a lot of poinsettias around. It's the holiday flower, and we see them everywhere this time of year. Well, in which country did that flower originate? If you know or just want to take a guess, just send your answer or your best guess to trivia@realestateguysradio.com. Include your name and your mailing address so that if you're correct and you're quick, we can send you a copy of CPA Tom Wheelwright's great book, Tax-Free Wealth. That is today's real estate trivia question. We're talking about the recent hike of the interest rate, and it's really, a range of interest rate that the Federal Reserve has come out after all these years of no change and said, we're going to raise it, we're going to raise it, we're going to raise it. And they finally did, and there's been all kinds of market reaction to that.
Yeah, and this really affects financial markets a lot more than it does, at least directly, real estate markets.
Yep.
But then again, it affects the way banks and corporations behave, which ultimately will affect real estate investors.
You bet.
So those are all things that we need to be concerned about.
Well, one of the things is, as we look as real estate investors, I'm looking at any change in the marketplace, whether it is, like we talked about, the price of oil. Some of that's good, right? My tenants now can afford more rent if gas costs them less. At the same time, if my tenants have jobs in those industries, they could be at risk. So part of what you do is you look at which tenants are being affected the most by any change you hear about. And are those tenants, if they're your tenants, going to be able to continue to pay? So the durability of your rent is a thing to consider in any news event.
Yes, you obviously need to stay focused on what's going on in your regional economy, your local economy, because that's where you're living. The only exception would be, we talk about farmland investing. If you're investing in farmland, it's maybe less important that you get the geography right, unless, except for the quality of the crop. But what you're really interested in is getting the commodity right, and then it can be shipped anywhere in the world.
Yeah.
So commodities in general right now have been suffering, and that's been a direct result of a strong dollar. And so think about this. If you have a local economy that is commodity dependent. We've been talking a lot about oil and gas, but it isn't just oil and gas. It's any commodity. Miners are laying off right now. So if you're in a mining community, coal, copper, zinc, if you're in lumber, there are commodities right now that are being hurt because commodities are priced in dollars and the dollar is getting stronger. And the dollar is getting stronger not just because of the quarter point rise, but it's also getting stronger because when the Fed does this, it actually creates difficulties in the emerging markets. Okay, this is where your head is going to explode. But
so follow along here. It's not that difficult to grasp, but you are going to have to think a little bit.
Yeah, so I'm not going to profess profess to be an expert in foreign exchange and currency markets, but I've been paying a lot more attention to them lately because the last time that Janet Yellen did not raise the rates in September, she said it was because of what was going on in emerging markets. And the concern is that the dollar was getting too strong relative to emerging market currencies. And when emerging markets currency or any country's currency goes down, it makes their exports less expensive for their foreign customers to buy.
Yep.
Okay, so it's like you lowering your prices and being more competitive on the open markets. Conversely, when your currency gets strong, then it makes your product less competitive in the global markets.
So with a strong dollar right now, there are some good things about that. The challenge is exports of the U.S. become expensive to other places.
Right. So if your local economy is being largely driven by a company that does a lot of exporting, especially one that is doing exporting to a country like China, who has been on a little bit of a decline, and on top of that, they have been devaluing their currency, the yuan, in relationship to the dollar. It means those dollar-denominated exports from the United States trying to be sold into China or other countries are now more expensive, which means it's harder for the U.S. company to compete. It's one of the reasons why a lot of the U.S. companies who are selling abroad don't necessarily like a strong dollar policy. Now, the good news is the dollar's able to buy them more labor, the dollar's able to buy them more land or capital equipment or whatever in the markets they're in.
Well, quick aside, right now is an excellent time in certain foreign real estate markets to be an investor in real estate. There are sales because of the exchange rate, and we look to exploit when those things happen. Either way. So again, a strong dollar isn't a bad thing necessarily. It depends on which side of the equation you're on.
Well, so coming back to an interest rate rise, creating a strong dollar, a stronger dollar, and now a stronger dollar creating pressure on commodity prices downward, which we're seeing. And again, we've talked a lot about oil, but other places. Australia and Canada are two countries that have been okay places to invest in, especially Australia over the years, right? But now they're suffering. They're suffering partly because the Chinese economy is down, and Chinese economy has been the largest consumer of commodities in the world. And so with that demand down, those sales are down. And on top of that, the dollar value of the sales is down because the commodities prices have gone down in dollars.
Yeah.
So again, it kind of makes your head want to explode. But if you just spend time thinking through it, it is logical. And if you start to pay attention to it little by little, it will start to make more and more sense. And then you just have to keep following the path all the way back to wherever you're invested. So we have listeners all over the world. We have people listening to us in Canada, in Australia, in Hong Kong, in addition to in the United States and many other countries. A lot of you are on the other end of a strong dollar. You're on the end where it takes more and more of your local currency to purchase the dollars you need. In many countries, real estate sales are denominated in dollars, not the local currency, for this very reason.
Good
because
point.
It's more stable currency. And so now when you go to buy, it's going to cost you a lot more of your local currency. So as an American, we can come in using our dollars and purchase your assets and get more for our money. Whereas the reverse is true, right? If you're there and you're trying to purchase real estate competing with Americans coming in with dollars using your local currency, you need more of it. And so as you're thinking about all of this, especially if you're an international investor, you need to be thinking about the role of the dollar in your local economy and the relationship of your local currency to the dollar and how that could affect both the price of the real estate, but also the jobs that might support the people who are going to be using the real estate. If you're in a resort community, it can be good, right? Because now you got strong dollars coming into the resort community and you're doing well. If you're in a community where maybe it's local industry and their biggest customer is the United States and they're trying to sell, that could be okay, right? Because they're going to do well. If you're there and you're trying to sell something that's going to be denominated in dollars, and now you're going to have a problem. So talk to the people who who are in these different businesses and begin to understand what it looks like through their perspective. I think one of the best things that you and I are able to do, Robert, is we get to travel around a ton. We get to talk to a lot of different people who look at the problems and the challenges and the opportunities through different lenses. And then we can begin to take all those little pieces of the puzzle and put them together and get a broader perspective. In fact, that's the summit coming up in February. At the end of February, we get a chance to do that. that. We get probably 100, 120 investors from all over the world, and they come in and we sit down and we have these conversations like, okay, well, what's life for you like now that the dollar has gotten so strong? What's that doing for you in your local economy? And how does the Fed, because everybody around the world is watching what the Fed's doing. It's not just the United States that's fixated on it. It's everybody because it affects everybody. The dollar is the global reserve currency. And even though it's diminishing in its role, it's still the big horse by far and away. And so anything the Fed does affects the value of the dollar globally, which affects every man, woman, and child on planet Earth that conducts business in any way, shape, or form. So it's very, very important for you to pay attention to it, even though it's a little bit of a brain strain.
Well, what's great about being on the summit this coming year is the fact that we'll be able to have those conversations with Mr. G. Edward Griffin, who wrote The Creature from Jekyll Island, and a wonderful expose on the Federal Reserve. Great book, great man. Robert Kiyosaki, who certainly has his mind all over economics, and just to hang out with that guy is brilliant. We're going to have an owner of a bank and a gold expert. So we've got lots of different people coming, and of course we'll talk oil, because oil is in the news. Oil is going to affect us in real estate in a lot of different ways. So join us. There's a few cabins left for the 14th Annual Investors Summit at Sea. Get all the details on our website at realestateguysradio.com under Summit. We come back, we'll talk more about things you can do in light of the new Federal Reserve move. You're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Need help with your real estate investment portfolio? Check out the resources page at realestateguysradio.com.
Are you achieving everything you want in life? What if there was a time-tested way for you to get everything you've dreamed of? The most successful people in life set goals and keep themselves accountable. But how? The good news is that it's not rocket science. You too can learn the skills and unleash the motivation that will create success in your life. And now is the time. Hi, this is Robert Helms, and I'd like to personally invite you to attend Creating Your Future, the 2016 Goals Retreat, taking place January 8th through 10th in beautiful San Diego, California. This unique weekend has been called phenomenal, inspirational, and life-changing by the hundreds of people that have attended. Find out more at realestateguysradio.com and click events, or call 888-489-7723, extension 18. Get your life back on track, physically, spiritually, and financially. Attend the 2016 Goals Retreat on the second weekend of the new year. Click events at realestateguysradio.com and register while there's still early bird pricing. This is no dress rehearsal. Live the life you were meant to. Visit realestateguysradio.com or call 888-489-7723 today.
Hi, this is Donald Trump, and you're listening to The Real Estate Guys.
And welcome back to the Real Estate Guys radio program. Thanks for tuning in to the show. If you've ever thought about doing bigger deals by raising money from other investors, then you owe it to yourself to come out to the Secrets of Successful Syndication. It happens January 29th and 30th in Phoenix, Arizona. The amazing Ken McElroy will be there, attorney Mauricio Raoul, and a great cast of faculty, including a couple of new folks this time around. To get all the details at realestateguysradio.com under events. Talking today about how the Federal Reserve rate increase here is affecting real estate investors. And I think the main thing to focus on is where is housing going? Where is affordability going? Where are tenants going? The good news, and we'll cover this in more detail next week, and I know we keep teasing next week's show, but before we're done, I'll tell you why I'm very excited about the 4 at least guests we'll have next week, is that there are more and more renter households. More people today than in a long time are renting. They are choosing not to, or they can't afford to own, or they can't get loans. And so there's more renters. That bodes well for real estate investors. Interest rates continue, in spite of this uptick from the Federal Reserve, continue to be great. And again, next week we'll learn about some loan programs that aren't dependent on your credit, which is fabulous. So all in all, not a bad time to be in the real estate investing business.
No, it's great. You know, the key is just to make sure that you pick rock solid markets and diverse markets, the things we preach about here all the time. You know, you want to have those wide variety of diverse drivers. You know, you don't want to be in the one trick pony town where it's all about the one industry or the one company. So you need to make sure that you're diverse, and then invest in the bread and butter properties, invest in things that people will always need, that aren't fads, that are affordable. And think about your macroeconomic considerations within the scope of maybe a state and it being job friendly and aggressive
or tax friendly.
And tax friendly. Those are things, you've got to watch the big baby boomer demographic. You need to watch what the millennials are doing because they'll begin to give you some indication to what they're thinking and where they're moving. I think that it's important to pay attention to the credit markets right now because especially I don't know if you saw this, Robert, but a couple of big bond mutual funds basically blocked their investors from being able to liquidate. The idea of a mutual fund is you're able to go in there and get your money out whenever you want. It's highly liquid.
Right. I can sell, I can buy into it. It's liquid.
Now, we teach our syndicators don't ever do this, which is exactly what these bond funds do. And that is they invest long, but they have these mismatched maturities where they're giving you basically demand, like a demand deposit, but they're making these long-term investments. Well, if they have too many people come in and want their money out, they have to begin to sell these assets at whatever price they can get. And the problem is when too many people get spooked, and this is always the danger in paper markets, when you can move in and out, too many people get spooked, then everybody comes looking for their money, and it's just like a run on the bank. The only difference is it's a run on a bond fund. This is what blew up the financial crisis in 2008. This has the potential to do it again. So you definitely want to be watching that. Everybody's paying more attention to it now. So you want to be paying attention to that. Use financial structures that you feel very comfortable with being stuck with in the long haul. Don't get penny wise and pound foolish. Don't think, I can save an extra $100 a month if I use this super teaser rate deal when the probability is rates are on their way up, not on their way down. I would be very, very careful about that.
Yeah.
So some people will use these loans, these balloon payment loans where it's 30-year amortized, so you get a low payment, but it's all due in 5.
Meaning that in 5 years you have to refinance it?
Yeah, you either have to refinance or sell, and that's all predicated on the value still being in the property. Meaning that you can still qualify, or there's lenders out there. I mean, back in the day when condo hotels were all the rage, a lot of these developers' projects were all predicated on your takeout buyers, the people you were going to sell the finished inventory to, having access to credit markets that would finance those purchases. When those loans went completely away, then there was no liquidity and these developments failed. And, so things can change and they start in the credit markets, and most real estate investors aren't trained and don't really pay attention to the credit markets. And I think big picture lesson from 2008 that we've harped on for, years now is savvy real estate investors got to pay attention to these credit markets. And when the big elephant in the room, the Federal Reserve, comes in and finally, after nearly 10 years, actually begins to move the rate, you have got to perk up. You've got to pay attention, because the last time they did this was 2006. Now, they went into an aggressive rate hiking cycle and it led directly to the crash. Now, this time they came out with a much more metered or muted languaging.
But they did also talk about gradual increase over time. This has definitely set the stage for more small increases. And if you just step back and look, that means it's probably an excellent time to make sure your financing is in place. It's long-term if your strategy is long-term. If you still have properties that you haven't refied, now's the time to take a look at that. You'll definitely want to pay attention to next week's show because of that. But real estate and these markets move slowly. An overnight reaction is not the ultimate reaction. Your mission is to pay attention, and now more than ever before, you better be paying attention.
And really know your demographic. Know where their money comes from. Not just that they have income or they've had a job for a couple of years, but what industry they're in, who their employers are, and then kind of who the major employers are in the area. And they may not be the people you're renting to directly, but you may be renting to people they do business with. So they may be an engineer or a scientist or a whatever that is a homeowner, but they do business with the guy at the laundromat. They go to the restaurant. They're getting their car done. They're doing business with, the local merchants. And these people are the people that you're actually renting to. But without these primary people in the marketplace, those jobs go away. So pay attention to that because, again, the markets are fragile. My estimation anyway, I think the markets are fragile right now. And even though things are booming, things that boom can dry up in an instant when people get spooked. And the evidence that these big mutual funds had to shut down, not one, not two, but 3 of them. The first time I read about it was only the one, then it was another one, then it was another one. If that's a trend that continues, you could begin to see bond markets lock up. And when this happened in 2008, it all unraveled very, very quickly. So if you've got credit lines out there that you are counting on for liquidity, I wouldn't do that. I would make sure I have some real cash on hand so that if things tighten up, you do have some liquidity that isn't a credit line.
Well, one of the big differences between our shows and a lot of real estate shows is we spend some heady time in the clouds talking about broader picture economics. To make up for that next week, it's all about single family houses. We've got a bunch of great guests next week, and a lot is changed in the single family marketplace, including financing. And you're going to learn next week about some great alternative financing that real estate investors should be excited about. Until then, it's the most wonderful time of the year. Make sure you're giving big hugs and high fives to the people that matter in your life. And let's all get excited for a new year, which is coming before we know it. Until next week, go out and make some equity happen.
Hello, this is Robert Kiyosaki, and I'm very excited that I'll be joining the Real Estate Guys for their Investor Real Estate Summit at Sea. Join me, join my friends, join the Real Estate Guys Investor Summit at Sea, and I'll see you out there. Thank you very much.
This episode of the Real Estate Guys radio show is brought to you by Paradigm Life. Powerful cash management strategies using life insurance. Learn more at beyourbank.com. Mid-South Home Buyers. Low-cost, turnkey cash flow properties in Memphis, Tennessee. Corporate Direct. Asset protection strategies for real estate investors from attorney and rich dad advisor Garrett Sutton. Find these and other great companies under the Resources tab at realestateguysradio.com. To learn how you can expose your product or service to the Real Estate Guys audience, call 888-489-7723 extension 4. That's 888-489-7723 extension 4. Or use the feedback page at realestateguysradio.com. Thanks for listening, and we'll see you next week right here on the Real Estate Guys Radio Show.